Hi, this is Charlie Moran. I'm a senior analyst here at Value Line. Two of my colleagues, Alan House and Nate Aikman, join me today. Today we are going to provide an update on the economy and stock market. We will then discuss our Value Line Select Dividend Income and Growth product, and finally answer any questions you may have. Please note that this presentation will be available on our website, valueline.com, and on our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those joining us for the first time, I want to provide a brief overview of who we are at Value Line. We are a New York headquartered corporation that has been providing investment research for more than 90 years. Our flagship product is the Value Line Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, 5 easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly in print and digital forms, is created by Value Line's research department, which is comprised of nearly 70 analysts, economists, data experts, and quantitative specialists. One thing I want to stress is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Value Line has no investment banking business with any company, including all the equities under our coverage. Value Line does not execute trades for its subscribers and therefore has no stake in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products or services we offer or our different tiers of subscriptions, that information can be found at valueline.com, or you can call 1-800-VALUE-LINE. Now let's discuss the economy and the stock market. Value Line's economic staff prepared this content. The world is in the midst of a global trade war, which commenced with the Trump administration implementing across-the-board 10% tariffs on 185 nations. President Trump also announced a series of reciprocal tariffs against those nations with the biggest trade advantages over the U.S., generally assumed to mean large surpluses. The implementation of the reciprocal levies, with the one exception being China, was subsequently delayed for 90 days as the parties attempt to renegotiate trade deals. Still, the intensified trade dispute between the world's two largest economies has the global equity and bond markets on edge. Meantime, the inflation situation improved in March. Specifically, the consumer price index fell 0.1% on a month-to-month basis, while the core CPI, which excludes the food and energy components, rose just 0.1%. On a 12-month basis, the CPI and core CPI increased 2.4% and 2.8% respectively, with both readings also coming in below forecasts. Likewise, the producer price index declined 0.4%, while the core PPI rose just 0.1%. From a one-year perspective, the respective PPI and core PPI rose 2.7 and 3.4%, with the rate of both advances easing from the February tallies. The more benign inflation readings give the Federal Reserve some wiggle room to cut rates if the U.S. economy were to fall into recession. First quarter earnings season is underway. The results from the big multi-sector banks, including J.P. Morgan Chase and Goldman Sachs, surpassed analyst forecasts. That said, the pace of earnings growth at the S&P 500 companies has slowed considerably from the rate of 18% witnessed in the final quarter of 2024. Wall Street also will be watching what corporate America is saying about the potential impact of the global trade war on U.S. industries. Our sense is that overall profit growth predictions will have a more negative tone than seen in recent quarters and sometimes may not be provided at all owing to the uncertainty created by the Trump administration's trade negotiations. In conclusion, volatility on Wall Street remains elevated as investors are worried about issues including global trade disputes, uncertain fiscal and monetary policies, weakening profit growth expectations, and rising Treasury yields. Given this unsettling backdrop, we recommend a diversified portfolio consisting of 55% in stocks of high-quality companies with reliable cash flows, generally paying consistent dividends and strong balance sheets. Now let's go to the screener. Now I will walk you through the selection process for the latest stock to join the Value Line Select Dividend Income and Growth Featured Portfolio, Deutsche Telekom. Ticker symbol is DTEGY. For this, we will turn our attention to the Value Line Stock Screener. I will now show you how to access it. Once signed in, head to the dashboard where I am already located. This is the main landing page for subscribers where you will find economic commentary, supplementary reports, and other up-to-date content. From there, we want to choose Browse Research and navigate to the screener. One thing I want to touch on is that the screener is just one element of our selection process and helps us sift through the thousands of equities in our database using targeted relevant criteria. Anyone can select any number of different screening criteria and come up with a list of stocks. However, what separates Value Line Dividend Income and Growth is that Value Line follows a process starting with specific complementary criteria to meet our goals under the supervision of deeply experienced Value Line analysts. Step 1, we will look at a safety rank of 2 or higher. We want to focus on companies that are safer than the average equity under our review. Hence, we will focus on companies that are ranked 2 or better for safety. Keep in mind that our safety system ranks stocks from 1 to 5 based on their relative risk profile. After screening for this ranking level, we have whittled our list down to 401 stocks. Step 2 would be a timeliness rank of 2 or better. We want to focus on stocks that are ranked to outperform the broader market averages in the year ahead. After screening for this factor, we are now down to 111 stocks. Step 3 is a dividend yield of at least 2.7%. We want to also look at the dividend yield. While we are looking for stocks that have solid dividend growth potential, we also want to focus on equities that have a yield that is above the Value Line median. After conducting this screen, we are down to 22 companies. And finally, step 4 is a projected 3 to 5 year annual percentage high total return of at least 15%. We want to focus on companies that have healthy total return potential for the 2028 to 2030 investment horizon. We will focus on stocks which at the higher end of our predicted future price range will have earned 15% or above total return. After running this screen, we are down to 8 stocks. They are Deutsche Telekom, Fujifilm Holdings, Medtronic, Merck, Premier Incorporated, J.M. Smucker, Sunoco Products, and Toyota Motor Corporation. You will likely be familiar with the names of some of these well-established businesses. After a spirited discussion among our senior analysts and our chief economist, we decided that Deutsche Telekom, ticker symbol DTEGY, would be the newest featured selection of the Value Line Dividend Income and Growth portfolio. About the screener, Value Line subscribers have access to 15 preset screens and 50 fields. I should also mention that another 100 or so fields are available, but it requires a higher level of subscription. If this interests you, please call 1-800-Value Line. Please note that screens can be saved and revisited by utilizing the Create Save Screen button at the top of the page. Now let us click on Deutsche Telekom AG, where we find the landing page for the stock and Value Line's digital report. We can also click on PDF reports near the top right of the page to find the most recent full-page reports on Deutsche Telekom. Let us look at the most recent Value Line Dividend Income and Growth report. The Value Line Dividend Income and Growth report, which was published very recently, according to it, Deutsche Telekom is one of the largest telecom and broadband internet providers in Europe and controls T-Mobile USA, one of the U.S. Big Three wireless telephone companies formed by the merger of Sprint and T-Mobile stateside. As you can see on page 8, we look for the company to post solid top and bottom line gains this year on the heels of a sharp earnings increase in 2024. Deutsche Telekom's long-term growth is centered on sustainable revenue advances driven by technological innovation and strategic investments. There are a few primary segments that we believe the company will emphasize over the next 3 to 5 years. We believe that artificial intelligence, AI, will boost top-line growth in the coming years while also reducing costs and enhancing overall operational efficiency. In fact, the company is currently working on an AI phone which puts conversational artificial intelligence at the center of the user experience, potentially replacing reliance on specific apps down the road. The company has high aspirations for all of Deutsche's operations in the U.S. market. Specifically, its objective is to increase the number of customers for its fixed wireless internet service, a substitute for wired broadband service to the home, from 5.6 million at the end of 2024 to 12 million by the close of 2028. Deutsche also intends to boost its European presence by targeting service revenue growth of 3% per year on average over the next 5 years. Continued investments in fiber and 5G, the fifth-generation wireless communications technology, the 5G networks ought to help the company to achieve this goal. Deutsche Telekom shares are a solid investment choice for conservative income-seeking investors, particularly in the current environment. With the tariff situation in flux at the time of this writing, DTEGY stock is a relatively safe investment because it has a safety rank of 2, above average, while its beta coefficient is below that of the broader market averages. A healthy dividend yield also provides support for the stock price, particularly during more difficult times. Generally speaking, we try to hold positions in the dividend income and growth portfolio for at least 6 months before considering a sale. Of course, this depends on broader economic conditions and the health of the overall stock market. Generally, we try to diversify the DIG portfolio across a variety of sectors in order to help boost the overall return. While it may be tempting to focus on stocks in a high-growth segment, as the old adage goes, it's not a good idea to keep all of your eggs in one basket. It should be noted that while we screen for dividend income and growth selections, we also discuss qualitative factors that may add value to parameters that we screen for. The screens are good for quantifying metrics, though sometimes there are qualitative or intangible variables that are difficult to incorporate into a screen. Product brand awareness, management, and susceptibility to sharp economic downturns are just a few examples of factors that may be difficult to screen for. We hope this gives you a good overview as to how we screen for dividend income and growth stocks and what is included in our monthly report. We will now tackle a few questions. Please note that we typically cannot answer complex questions about specific stocks on the spot. The first few questions were submitted prior to this presentation. I'll give it over to you now, Alan.
Thank you, Charlie. The first question that came in was, what factors should you consider for dividend-paying stocks? The
Seems like Alan may be having some technical difficulties. But I think one of us can potentially pick that question up. The question was, give me just a second to find it.
Nate, can you hear me?
Oh, you're there. Hello.
Oh, okay.
okay.
Can you guys hear me now?
Okay, sorry about
Yes.
that.
Yeah. You were saying, I think I finally found the question. What factors should you consider for dividend stocks?
Yeah, can you hear me now?
Yes.
Okay. Yeah, I can handle that question. I apologize. I have some technical difficulties. There's several factors that people should consider when looking at dividend-paying stocks. The first is the dividend yield. The dividend yield is the annual dividend payment as a percentage of the stock's current price. It is a key metric for evaluating how much income you'll receive relative to your investment. There's also the second thing that you should look at is the dividend payout ratio. The dividend payout ratio is a percentage of a company's earnings paid out as dividends. It helps to assess whether the company can maintain its dividend payouts. What to look for? A payout ratio is typically between 30 to 60%. A lower ratio may indicate the company is reinvesting for growth, while a higher ratio, above 80%, could signal that the company is distributing too much of its earnings, which might not be sustainable in the long term. Also, it's good to look at the dividend growth history. Dividend growth refers to the company's track record of increasing its dividend over time. A consistent history of raising dividends signals a company's financial strength and management's commitment to returning value to shareholders. What to look for here is companies that have increased their dividend for many years, ideally for 5 years or more. Dividend aristocrats, which are companies that have increased dividends for at least 25 consecutive years, are excellent candidates because they have shown commitment to shareholder returns. Another factor to look at is the financial health of the company. This is a company's ability to maintain and grow dividends, which is tied to its overall financial strength. Strong cash flow and manageable debt levels are essential for a company to continue paying dividends, especially during economic downturns. Earnings or earnings per share growth over time is important to ensure that dividends will continue even during more difficult economic times. Another factor that bears watching is business stability. This is especially within the sector. Some sectors are more reliable for dividends because they have stable and predictable business models. Utility, healthcare, consumer staples, telecom are often more resilient in downturns, while sectors like energy or cyclical businesses might be more volatile. What to look for is companies in stable recession-resistant industries such as utilities, consumer staples, healthcare, telecom, which we have today, These businesses often generate consistent cash flows even in economic downturns, which supports reliable dividend payments. Also, management's commitment to dividends is important. A company's management philosophy towards dividends is important. Some management teams are committed to returning profits to shareholders through dividends, while others might prioritize reinvestment, acquisitions, or other endeavors. It's best to look for companies where management has a clear history of prioritizing dividends, especially those with stated dividend policies that align with long-term growth. Another factor is valuation. This is a company's stock price in relation to its earnings, assets, and dividends, and it can tell you if a stock is overvalued, undervalued, or fairly priced. What to look for is stocks that are fairly valued based on metrics such as price to earnings, price to book, and price to free cash flow. A stock that's overvalued could face downward price pressure even if it pays a high dividend. Avoid overpaying. High quality dividend stocks should be bought at a reasonable price. So assess whether you're getting good value for the expected dividend the expected dividend income. There's a couple more factors here. One is the dividend coverage ratio. This ratio measures how well a company's earnings can cover its dividend payments. A higher dividend coverage ratio means the company is less likely to cut its dividend. What to look for is a dividend coverage ratio of 2 or above is ideal. It means that a company is earning twice the amount it needs to pay its dividends, which gives it a safety buffer in case of unexpected declines in earnings. And finally, economic and market conditions. Dividend-paying stocks can be sensitive to changes in interest rates. In a rising interest rate environment, fixed income investments like bonds may become more attractive, making high-yielding dividend stocks less appealing. Inflation can also erode the purchasing power of dividend income, so look for companies that have a track record of increasing dividends faster than the rate of inflation. We have another question here. How are dividend-paying stocks good in volatile markets? And that's an excellent question, being what's going on right now. Number one, they provide a steady income stream. Even if the stock price swings widely, dividend-paying stocks still provide regular income that's like getting paid to wait out the storm, so to speak. This income can cushion the blow during market downturns. Also, implied financial strengths. Companies that consistently pay and even increase dividends usually have strong cash flows and solid balance sheet. That stability can be reassuring when other parts of the market are shaky. Also, lower volatility. Dividend-paying stocks, especially from big established companies, tend to be less volatile than non-dividend growth stocks. Investors often flock to them for safety, which helps stabilize their prices. They also provide a total return advantage. In volatile markets, capital gains might be hard to come by. Dividends contribute to total return, which can make a big difference if share prices are flat or declining. Also, they also offer reinvestment opportunity. If you're reinvesting dividends, you're essentially buying more shares during downturns when prices are lower, which can ignite your returns when the market recovers. Thank you. I'm not seeing any further questions. Charlie or Nate, do you see any questions?
I see one we can really rapidly address. We've been asked if we can re-show how we got to this longer report, since that was done fairly quickly. To get to there, it's pretty simple. You'll just navigate to the Value Line dashboard, the same place we started from with this presentation. And then if you look at the quick links section there, you'll have a bunch of links corresponding to our different products. Whichever ones you have on your account will be live, and they'll be green, and you can click on them. If there are any that you don't have, they'll be grayed out, and you'll get this little message if you hover over them. To get to that report, in this case, you would just click on the one for the Dividend and Income and Growth product, and then you would see the latest company report there. There'd be supplementary reports there. And so just clicking on that gets us right back to this full-length report that we were just looking at. And I think that's our questions for today. So go ahead and close us out.
Thank you. Thank you, team, and thank you, everyone, for joining today's webinar. This does conclude today's event. You may now disconnect your lines and have a great day.